Hello and welcome back to Talk Tickers. This is the show where we strip away the noise and get straight to the signal for the experienced investor.
It's good to be here.
Today, we are looking at a ticker that is sitting right at the intersection of, consumer health, interest rates, and the auto market. We're talking about Ally Financial, ticker symbol ALLY.
Yeah, Ally is always a fascinating bellwether. If you want to know how the American consumer is handling their car payments or what the deposit war looks like for these digital banks, this is the print you look at.
Exactly. And today is January 21, 2026. We're looking at their fourth quarter 2025 earnings. And I have to say, looking at the screen this morning, we've got a bit of a mystery on our hands.
A mystery.
A classic conflict. Ally delivered a beat. They beat on the top line, they beat on the bottom line, and yet the pre-market reaction is, well, it's chilly.
Chilly is a polite way to put it. I mean, we're seeing shares indicated down about 3.7%.
Wow.
Yeah, we're talking at a drop of $1.57, putting a stock right around $40.85. And this is a perfect example of the market trading the trajectory, not the quarter.
Right.
The headline numbers look fine, solid even, but underneath the hood, there are some concerns about the path forward, specifically on margins and credit.
So the vibe is definitely neutral to cautious. It feels like the market is saying, great job on 2025, but we are terrified of the first few months of 2026.
That's it, in a nutshell.
Okay, before we get into the fear, let's give credit where it's due. Let's unpack the headline numbers just to set the table. What did they actually report?
Sure. So for the adjusted earnings per share, EPS, they came in at $1.09.
$1.09. And the street was at what?
Street consensus was sitting at $1.03. So that's a 6-cent beat, which is roughly a 5.8% positive surprise. On the GAAP side, reported EPS was 63 cents.
Okay. And on the revenue side?
A small beat there, too. Revenue came in at $2.17 billion against expectations of $2.16 billion. And, total net revenue on a GAAP basis, that was up 4.8% year over year.
So operationally, the machine is working. They're generating cash.
It is.
Right. And usually when you see a beat on top and bottom like that, you expect a little confetti in the pre-market, maybe a nice 2 or 3% pop.
You'd think so.
Instead, we're seeing this heavy sell-off, and the volume is massive. Over 9 million shares traded already. That's nearly 3 times their normal average.
That volume spike is the tell.
Ah.
That tells you institutions are repositioning. This isn't just retail noise. The big money is digesting a specific piece of guidance that came out of the call, and they're voting with their feet.
So it seems that beating expectations simply wasn't enough to satisfy the crowd today.
Not even close.
Okay, let's find out why. Let's get into the deep dive. I want to start with what we call the engine room net interest margin, or NIM.
The lifeblood.
Exactly, the lifeblood of a bank like Ally. For anyone who doesn't live on bank balance sheets, it's the spread between what a bank earns on loans and what it pays out on deposits. Where are we standing?
So for the fourth quarter, net interest margin ex-OID came in at 3.51%.
3.51. Okay.
That's the starting point. That's the now.
And is that good, bad, indifferent?
It's respectable. It shows they're managing their funding costs well enough. But the problem isn't the number itself. It's the forecast. Looking ahead, management, specifically CFO Russ Hutchinson, is guiding the full year 2026 NIM to land between 3.6 and 3.7%.
Okay, which sounds like an improvement. If they're at 3.51 now and going to 3.7, that's an upward trajectory. So where's the disconnect? Why the sell-off?
The disconnect and the source of all this anxiety today is the immediate future. They issued a choppy warning. Hutchinson explicitly said that NIM is expected to be down slightly in the first quarter of 2026 before it starts expanding again.
There it is, the dreaded down before up guidance. Wall Street hates that.
Hates it. They want up immediately.
So why is it dipping? Is it deposit costs? Are they having to pay us too much for our savings accounts?
Surprisingly, it's not just deposit costs. The real villain here is actually on the asset side, specifically lease residuals.
Lease residuals.
They are seeing pressure on the resale values of a very specific type of vehicle, plug-in electric hybrids.
Plug-in hybrids, that is incredibly specific. I would have expected you to say used cars generally, or maybe large SUVs. Why plug-ins?
It's a perfect storm for that asset class. Think about it. You have the expiration of EV tax credits, which hurts the value of used models.
Right.
You have some OEM recalls affecting specific models. And heavily, you have massive incentives on new cars.
Right. If I can buy a brand new plug-in hybrid with a huge rebate, why would I pay a premium for a 3-year-old one?
Exactly. The used price collapses. and Ally has exposure to these leases. Remember, in a lease, the bank owns the car.
They own the asset.
Yes. And when that lease ends, they have to sell it. If the car is worth less than they predicted 3 years ago, they take a hit. And that hit flows directly through to the NIM. That's the pothole they're hitting in Q1.
That makes a lot of sense. It's like a pothole in the road for Q1. But looking past that, what's the bull case for the margin? Because they are still saying they'll exit 2026 approaching the upper threes.
The bull case is entirely macro-driven. Their model is built on the assumption of 2 Fed rate cuts in 2026.
Okay.
This brings us to a key concept. Ally is liability sensitive over the medium term.
Let's pause and define that for the audience. Liability sensitive. What does that mean in plain English?
It means their liabilities, the money they owe depositors like you and me, reprice faster than their assets, the loans they made.
Okay.
So right now, they're paying high interest rates on savings accounts. If the Fed cuts rates, they can lower those savings rates pretty quickly. But the car loans they made at 9%, those stay on the books.
So their costs drop faster than their income drops.
Precisely. The spread widens. They believe that as we get through 2026, deposit betas will fall, the Fed will cut, and that margin will expand significantly.
So if you believe the Fed cuts are coming, the Q1 dip is just a speed bump. It's a technical issue with hybrid cars, not a structural issue with the bank.
That is the bull case. But in this market, investors hate speed bumps. And they are looking at that Q1 dip and wondering, what if the Fed doesn't cut? That uncertainty is why the stock is down.
Okay, let's shift gears to the other massive topic, credit and the consumer, the normalization narrative. We've been hearing this for 2 years. Credit is normalizing, which is banker speak for people are starting to default again. How did the loan losses look?
Better than promised, actually. Retail auto net charge-offs, or NCOs, landed at 1.97% for the full year.
Just under that 2% ceiling they promised?
They came in under the wire, which is a win.
It is a win, although I noticed Q4 specifically was a bit higher, right?
Yes. Q4 NCO was 2.35%, but we have to be careful there. That's largely seasonal. People tend to fall behind on bills around the holidays. The market expects that seasonality.
Right. The full year number and the guidance are what matter.
Exactly. And for 2026, they're guiding retail auto NCOs to be between 1.8 and 2.0%.
That seems stable, maybe even improving.
It is stable. But this raises the big question that analysts were hammering on the call. It's the Sherlock Holmes question. The dog that didn't bark.
Why no reserve release?
Exactly. Why no reserve release?
Right. Let's explain that. When a bank expects bad loans, they set aside cash in a reserve. It hurts earnings today to save for tomorrow. If credit is getting better, usually banks release some of that money back into the profit column. Ally isn't doing that.
No, they aren't. And their defense is very telling about their view of the U.S. economy. Management explicitly said they're banking on higher unemployment in 2026 compared to 2025.
Whoa. Okay. So they're holding onto the cash because they see storm clouds on the horizon for the job market.
Precisely. They are holding reserves against macro uncertainty, specifically the labor market, not against the current performance of their portfolio. The portfolio looks good, delinquencies are down, but they are looking through the windshield at 2026 and seeing potentially fewer jobs.
That is a tough message to sell. Our loans are performing great, but we don't trust the economy. It feels a bit like sandbagging, doesn't it?
It could be. Could be sandbagging, or it could just be prudence. Remember, Ally is a consumer bank. If unemployment spikes, car payments are one of the first things to get missed.
Sure.
By keeping reserves high, they're bulletproofing the balance sheet. But it means investors don't get that short-term earnings pop from a reserve release today.
However, despite this tougher outlook, they aren't stopping the machine. I saw they originated $9.3 billion in Q4 with a yield of 9.6%.
Nearly 10% yield. That is juicy.
That is incredibly juicy.
It is. And crucially, they're keeping the quality high. They mentioned keeping their S-tier mix, that's their highest credit quality borrowers, around 43%. They aren't chasing subprime growth just to put numbers on the board.
That's key. They're growing, but not by lowering their standards.
Okay, let's talk about what they're doing with the money. Capital allocation. We saw a headline about a buyback.
Yes, CEO Michael Rhodes announced a $2 billion share repurchase authorization.
$2 billion? That sounds like a big number. That's roughly, what, 15% of their market cap?
It's a big headline number, but the execution is what matters. They describe their approach as low and slow.
Low and slow.
In fact, since the authorization in December, they have only bought back $24 million.
$24 million out of $2 billion. That's barely dipping a toe in the water. That's a rounding error.
It is extremely cautious, and it goes back to that conservative view on the economy. Their primary goal right now is building their capital ratios. They want their CET1 capital to get to that 9 to 9.5% range.
Safety first. Prioritizing safety over handing cash back to shareholders right this second. The end game is a mid-teens return on tangible common equity, or ROTCE, but they're guiding 9 to 11% for 2026. So they're telling us 2026 is a building year.
It really feels like a show-me story. Management is promising what they call the story of, and growth and buybacks. But the market, looking at that paltry $24 million, is skeptical.
That's the perfect way to frame it. The market is saying, we see the authorization, but we don't see the cash leaving the building yet.
Okay, let's zoom out a bit. We've covered in and credit. How does this fit into the broader investor context?
Consumer lenders are currently in a massive tug of war. On one side, you have credit normalization. Are people going to pay off their loans? On the other side, deposit competition. Everyone is fighting for cash.
And Ally's right in the middle. But they've been doing pretty well recently, haven't they?
They have. Over the last 3 months, Ally actually outperformed the SPY. They had a strong run-up.
Ah, so high expectations.
Exactly. The bar gets raised. You can't just be good. You have to be perfect. The drop we're seeing today is partly a classic sell the news event. Investors positioned for a perfect print. They got a good print with some anxiety, so the fast money is exiting.
So for you listening and watching this stock, what are the actual catalysts? What changes the narrative from cautious to buy?
3 things to watch like a hawk. First, evidence that NIM holds that 3.4 to 3.6% band. If it dips below 3.4, look out.
Okay, hold the margin line. That's one.
Second, we need quarterly confirmation that losses stay in that 2.0 to 2.4% lane. If NCOs spike to 2.5, 2.6%, the thesis breaks.
And the third?
Earnings power. Can they grow earnings without buying risky growth? If they can keep that S-tier mix high and extend margins as rates fall, the stock re-rates higher. It basically comes down to, can they stick the landing in 2026?
Okay, that is the rational, sensible analysis. But this is Talk Tickers, and we like to close out with something a little more provocative. It's time for our This Is Not Financial Advice segment.
My favorite part of the show.
This is where we pitch a trade idea that's outrageous, maybe a little dangerous, but plausible. Like, we're hedge fund analysts pitching to the investment committee after 3 espressos. What do you have for us?
Okay, I call this trade the EV residual arbitrage, or, if you want to sound fancy, the curve steepener play.
I'm listening. What's the setup?
The thesis is this. The market is over-penalizing Ally for a very specific problem, the plug-in hybrid lease residuals in Q1. Everyone is freaking out about these used EV values.
Right, the pothole we discussed.
But think about Ally's structure. They are a diversified bank. Their deposit beta, their cost of funds, is going to drop way faster than their asset yields when the Fed cuts.
Because of that massive deposit base.
Yeah. So the trade is this.
Yeah.
You go long Ally aggressively on this dip. You catch the falling knife.
Okay, an aggressive long on Ally. You're betting the market is wrong. What's the hedge?
You pair it against a pure play EV lender or a manufacturer with high exposure to these expiring tax credits. You short them.
Oh, that is spicy. So you are betting that the drop in used EV prices is an industry-wide disaster.
It is. But Ally has a diversified book of traditional gas cars to survive it. The pure play EV guys, they don't. They are stuck with falling asset values, and they don't have the cheap funding advantage Ally gets when rates fall.
So you're betting that Ally's choppy Q1 is actually the bottom, the kitchen sink quarter.
Correct. You're betting that once they clear that hurdle, the exit rate of 2026 forces a massive multiple expansion as their margins explode upward, while the EV-focused competitors are still drowning in depreciating metal.
I love it. You play the bank that can weather the storm against the lenders who are the storm. It's a relative value trade on the death of used EV prices.
Precisely. It's risky, but the logic holds if you believe the Fed cuts are coming.
And just to be absolutely clear to everyone listening, this is a scenario analysis. This is not financial advice.
Yeah.
Do not go leverage your house based on a podcast segment.
Please don't. We're just reading the tea leaves here.
All right, let's wrap this up. Recap for the people in the back.
Ally beat the quarter. $1.09 EPS. Revenue up. But they lost the morning on guidance nuance. that Q1 margin dip from hybrid car values, and a cautious view on unemployment.
It really is a battle between the solid 2025 in the rearview mirror and the higher unemployment visible in the windshield of 2026.
Okay.
The bank is being conservative. The market wants them to spend now.
That is the story. The market needs a few more months of proof.
Well, make sure you check your own models, look at those residual values, and decide for yourself. That is all we have for today's deep dive into Ally Financial.
Thanks for listening.
Remember, markets close, but the analysis never stops. We'll see you next time.